It's great to have everybody here. Since I don't know everybody, and I know we have folks joining on Facebook, my name is Michael Goldberg, and I'm the executive director of our Veale Institute for Entrepreneurship, and also am a professor at Weatherhead, where I teach courses on entrepreneurship. And it's great to have Ver Ploeg as part of our CWRU Entrepreneurship Alumni Speaker Series. Sometimes we have non-alums, but we get to throw the alums in when we have our proud alums. So Eric, thank you so much for making the time to do this today. Vaibhav, who's one of our awesome MBA students, actually an integrated student, is going to be the moderator. The format for those who are joining for the first time is that these are all student moderators. So we make the students do the work, which is great. So Vaibhav will moderate. If you're on Zoom or on Facebook, please go ahead if you have questions. We like these to be as interactive as possible. So put your questions that you might want to ask Eric either in the chat or let Vaibhav know. We'd love to have you ask them directly. So if you're game for unmuting yourself and asking the question, that'd be great. If not, Vaibhav can ask it for you. And we will go from there. And I see we have a few more. Sasong and Emily are on, part of our recent grads who went out to San Francisco with us as part of our trek. It's nice to see you. And Rohan also, Sinha, was part of our trek. So welcome. And with that, Vaibhav, let me turn it over to you.
Thank you, Professor. So good afternoon, everyone. Thank you for joining us today for the CWRU Veale Institute of Entrepreneurship Speaker Series session. I'm Vaibhav Khurana, MBA MSM Finance student at Weatherhead School. Today we have with us Managing Director of DTCP and case alum, Eric. Eric is an accomplished venture capitalist with success in corporate and financial venture investment groups across all companies' maturity stages within fintech, mobility, marketplace sector, entrepreneur, SaaS, etc. He's also an active angel investor, in pre-Series A companies. Before starting his venture career, Eric started 2 venture-backed companies and raised 5 rounds of funding from companies such as Kleiner Perkins, Mayfield, JMI Equity, amongst others. Eric completed his bachelor's in electrical engineering from Case Western Reserve and then went on to do his MBA at Stanford. Currently, he's managing director at DTCP, Deutsche Telekom Capital Partners. Welcome, Eric, and thank you for joining us.
Thanks for having me.
Great. So let me start by asking you the first question. Can you share something about your career journey? How did you reach where you are right now?
Sequence of happenstance and good fortune and bad luck. I was always interested in the overlap of business and science. As a kid, even, my parents were science type people by profession, which sort of was a natural following in the footsteps. I don't know where the business interest originally came from, but I know my parents were supportive of that. I think more from just being supportive of me than any actual interest in their part. I think they always thought the business was a little bit dirty, from a pure scientist perspective. But I ended up at Case, in doing electrical engineering work, and that was the first place where I had heard of Moore's Law, and I remember having maybe epiphany is an overstatement, but I remember thinking, wow, that's going to keep going for a long time, like for the next decade or 2 or 3. I should kind of hook my wagon up to that mega trend. And maybe I was a little bit overly literal in saying, okay, I'm going to do semiconductor device physics at Stanford, but I think that directionally that was a good call, right? Like it was just getting onto an up escalator is a happier, better place to be than in a shrinking industry. Mm-hmm. So I ended up at Stanford. I was just going to get a master's degree and then go do the high tech entrepreneurship-y stuff. But I saw that a lot of people in the Valley were doing, who had PhDs, were doing things that I admired. And they were CEOs of companies and partners of venture firms and just doing a lot of interesting things. And so I managed to pass the qualifying exams to get into the PhD program and get in a great research group with the guy who ended up becoming the head of the dean of the engineering school, and really enjoyed that process. And then ended up getting an MBA, got into that program, focused completely on high-tech entrepreneurship, and started 2 venture-backed companies, which I don't know if there's a one best path to venture, but that's a pretty good one, is, going through the process of actually starting a company is pretty good. The key point for me happened at sort of a break point in the second company when there was a natural sort of change in things, and one of my board members said, "Hey, had you ever thought about a career in venture?" And I remember, I'm not a very tactful person, but this time I was tactful enough to not say the following thing out loud. But in my head, I thought, I don't know. I still have enough fight in me. I'm not ready to retire into venture capital. I mean, that looks like a 30-hour-a-week job if you include golf. So I said, but I did say with an out loud voice, that sounds interesting. Let's dig into that a bit. And I had a bunch of meetings with people who were in venture, and that's one of the advantages of, coming out of Stanford, is that a lot of those people. Mm-hmm. And they disabused me of that notion that it was a 30-hour-a-week job. The more that I thought about it, the more I thought, that is like a kind of a good fit for me. And so I ended up joining Vantage Point Venture Partners, who led the Series B at the second company I started. And I ended up taking a board seat where I was chairman of the board of the company and representing Vantage Point's interests in the company. And I spent 8 years at Vantage Point, heading up the mobile practice there, and left venture for a handful of years after that. I was running a quant hedge fund, doing behavioral finance-based trading on the times when, specific instances where, we humans get greedy or fearful, and taking the opposite side of that, which was a fascinating intellectual undertaking, but kind of lonely, and was anxious to get back into venture. And so I just started doing my own venture investing for a couple of years, and then that segued naturally into the role here at Deutsche Telekom Capital Partners. And I've been an MD here for 3 years.
Great. So it seems like you had a very gradual step-by-step sort of path. You didn't graduate from college thinking, I want to be a venture capitalist at the end of the day. It was more gradual. But in your experience, have you met people who've had, what's the mix of people who go to schools and say, I just want to be a venture capitalist? Do you see that trend sort of happening with students?
I see that, but I think it's not a trend so much as a symptom of a long bull market. Unfortunately, we're at the end of it, but we are at the end of the longest bull market of my lifetime. And in a long, protracted bull market, no one can get enough venture capital, right? It's super high beta equity that does fantastically well across the board in a bull market. And so it draws a lot of enthusiasm and people into it. And so to directly answer your question, yes, I definitely see that. I see in the last few years that, lots of people are coming straight out of, MBA programs or even, undergrad things like, I want to be a venture capitalist. Unfortunately, I think it's going to be tough, if this recession is anything other than a very short, sharp V-shaped recession. I think it's going to be tough to do it because the industry will just shrink a bunch. And in a shrinking industry, it's hard to be a new entrant.
Mm-hmm. Great. So you mentioned about the end of bull run, and my next question is actually related to that. We're all in the COVID-19 as of now, and we know that this is not a short-term, at least it looks like it's like a short-term trend or something. How has the VC funding space gotten impacted because of COVID-19?
I think of it in maybe 3 different kind of time periods, right? There's one answer if you're thinking about it in terms of months, another in terms of quarters, and another in terms of years. And so let me take those in turn. I think for the first few months, there are a couple obvious things. Like one of them is if you're in one of the sectors that's obviously directly impacted, like travel or hospitality or events, the direct impact in the first couple months has just been devastating. I mean, there's no way to overstate how bad that is for those sectors. I think outside of those sectors, it's been a little bit of a change, but has been surprisingly kind of business as usual. I think shifting to like thinking about the next few quarters, like the next 2 to 8 quarters, it really depends on how bad and deep the recession is, right? If it is a short, sharp V, or is it a long, deep trough? Officially, I'm a militant agnostic when it comes to looking at the crystal ball and knowing which of those two it is, because I don't think anybody has demonstrated an ability to predict that kind of thing. Mm-hmm. But in my heart, and I'm more fearful that it's the latter, that it's going to be a long, deep trough. And if that's the case, then the impact on the venture and entrepreneurship ecosystem is going to be severe. It's hard to overstate. Like maybe some anecdotes. In the late 90s, I think there were about 50 seed stage venture funds. I think one of them out of 50 survived the dot-com crash. So a 98% attrition rate is pretty severe. I think if we have a deep trough that, currently probably there are 300-ish seed stage venture firms. I don't think we'll have 98% attrition, but 90% attrition wouldn't be a bad guess if it's a deep recession. And so I think that's the way to think about it, is like it will be essentially impossible to start a new venture firm, and that most of especially the early stage ones, will go out of business if there's a protracted recession. So that's the next handful of quarters. Mm-hmm. And then the answer, I think, when you think about it from the next in the years, honestly, I don't think it'll be that big an impact. For companies that are being started now, or early stage investments that are being made, seed and Series A, the average time to liquidity is about 8 years. And so the chances of us looking back at 2020 when it's 2028 and going, oh my gosh, if I had only known that thing, then I would be a billionaire now. I just don't think it'll have that kind of impact. There'll be little changes. There'll be some acceleration of sort of work from home things, but those were trends that were happening already. I haven't seen anything that makes me go, this will change how the world will be in 8 years.
Okay. So we have some questions coming in from the attendees. Sisong, do you want to ask your question? Please unmute yourself.
Yeah, sure. Thank you very much. And also thanks, Derek, for being here. So you brought up a really great point about this excitement to be a VC. I mean, personally, I guess I fallen victim to that, where I'm like, oh, it'd be really cool to be a venture capitalist. But you do bring up a good point about the future of these firms. But I was curious, like reflecting back on your career, what are some of the most important lessons that young people just starting their careers should be trying to find, instead of searching for this like aspirational role that may or may not be sorry, I'm losing train of thought. May or may not be like foreseeable in the next couple of years. What are some other like main skills, main lessons, just things that are really important to hold on to or walk away with during this time, whether it be finishing up school or like jumping into a new role?
I think that's an excellent question. And I have 2 big pieces of advice in that vein. The first one is to get a mentor. And it doesn't have to be a mentor. It can be a collection of folks, and it can vary over time. But rather than trying to learn everything yourself from direct experience, if there's somebody who's a little bit older and experienced in the industry that you're interested in, who is willing to take time to give you advice, they've walked down that path before. And they're going to have insights and help you see the forest for the trees in ways that are unlikely that you would find in your first paths through the forest. So that's the first general piece. I think the second piece is, if you really want to do like, venture or high-tech entrepreneurship, maybe segmenting that, like the things you might go do of like start your own company or join a little tiny company is path number 1, and path number 2 might be joining a growth stage company that's well funded and the model's working, And then, path 3 might be, join a big company that's a public company and is well established. And I would make a really strong case for path number 2 for a number of reasons. One of them is once they're sort of established growth stage company, they attract really the best senior management, best middle management, best individual contributors, all want to come work for those companies because they're rocket ships and they're on a great path. And so rather than learning from the slowest way imaginable, which is you make your own mistake, you're like, okay, don't do that again. And then you make a new mistake, okay, don't do that. Rather than that, you're learning from people who executed beautifully before and were able to get into this rocket ship. And so I think there's a lot of learning that you get from joining a well-functioning, growth stage company. And plus you get sort of the brand halo and great network that comes from joining a company like that. That, if you join an early stage company or you start your own, you're talking like small single-digit % chance of that working. And so then you're like, wow, I made a bunch of mistakes. Okay, I learned some lessons, but I didn't make much money from it. And I don't have much of a network that comes from it. If you go to a big company, there are definitely, companies that are execute well, even though they're big public companies, but by and large, it's a different kind of people who aren't interested in entrepreneurship that end up in those companies. And so you get less of sort of immersion into that ecosystem, if that makes sense.
Yeah, definitely. Thanks a ton.
Thank you. Next question, Sanjeev, do you want to ask the question?
Yeah, I will. Thanks a lot for being here, Eric, and to all the other alumni who've taken the time to share their insights. My question is about the portfolio companies at DTCP and some of the issues that they're facing through the COVID crisis, as well as how DTCP is still focused on driving value and creating value in these companies going forward.
I would segment this, so thank you. So I'd segment that into sort of categories. Like the biggest near-term issue facing venture-backed companies in general is capital formation, right? If the coming quarters are a deep, long recession, then it will be very difficult for even reasonably high-quality companies to raise capital. The very best will always have access to capital, the top 5%-ish of the companies in terms of execution. But it will become very difficult for anything other than that top 5 or 10 or 15% of companies. And so that's the number one piece of advice, is just sort of an honest, and like hyper honest, assessment of the capital that one has available. And being able to go for the next couple of years without additional capital, that's the number one thing. I think to your question of how they're impacted and how we help them, that we can help them see the forest for the trees around, like, oh yeah, no, it's going to really be bad to raise capital. Like, if you need it next year, get it now, even if it means taking on less attractive valuation, take it now. I think the longer answer is it really kind of depends on the sector that they're in. So a company like Fastly, where we raised, we participated in the pre-IPO round, their capital formation part is kind of done, and they're in the public markets already, and they're a huge beneficiary of work from home and internet traffic, and so like they've been doing fantastic as a public stock. It's a mixed bag in the rest of the portfolio. Some are slightly assisted by the work from home acceleration. Some are noticeably hurt. We have 1 or 2 companies in the old portfolio that are in the ad tech world, and ad spending is noticeably down. Anybody who's reliant on spending from travel and tourism and hospitality is obviously taken a hit in the last few months. And so, but it's the same question, right? Like, how do you make sure that you have the resources required to get to the other side of this? And, in some cases, like, it's kind of business as usual. In other cases, it's having to really focus on the core of the business that's going to be exciting in 2 years and not indulging in the luxury of spending on some of the things that are a good idea that you wish you could spend on, but you just don't have the resources to do.
Yeah, thanks a lot. Appreciate it.
Eric, so a question based on that is, have you seen any impact on the proposals pipeline that VCs usually see on an average? Is there a dip in that? Like, are you seeing any trend around that?
It's a multi-leveled answer to that question. I mean, so maybe let's take the most positive answer to that. So there are companies that are high-quality companies that we've met with in the past couple of years that we couldn't get access to. We weren't able to talk our way in. The round was oversubscribed. Whatever the reason that we really wish we could have been able to do. So in March, when this was, COVID was starting to make people panic, and Sequoia had sent out their, sort of like end of days, email to their CEOs. And it's good advice, right? I was on a board with one of the Sequoia guys, and, he's like, walk through the rationale in a board meeting, and, it is good advice. And it creates sort of an opportunity for, getting access to companies that you otherwise might not be able to get to. So we reached out to those handful of companies, and it hasn't been announced yet, so I can't name the company, but super high quality company that we couldn't have gotten access to last year. We're going to be putting a $10 million investment into as part of a round right now. So that was one thing that we did. I think from the pipeline perspective, we saw sort of that wave, right? If everyone was getting that advice from their board of like, well, if you were thinking about raising, anytime in the next 12 to 18 months, now would be a good time to accelerate those plans. That was the great companies, the middling companies, and the crummy, barely alive companies as well. They all did that. So there was a bit of a wave in March of that. That's kind of played out. What I see in the ecosystem now is the very best venture firms are continuing business as usual and focused on their plan and path and their normal strategy and their normal deal cadence. And that the second, well, I'd say the third tier, right? The bottom half venture firms are saying, whoa, we need to slow down. We need to husband our cash. We need to maybe, we'll see multiple compression here in the coming quarters, and we can get, good prices. And in the back of their head, they're also thinking, maybe we can't fundraise for the next fund on the timeline we were thinking, and maybe we should stretch this one out a little bit longer. So I think those are the main dynamics we're seeing. There's I don't know, this is my own observation that is, my opinion. I wouldn't take this as venture gospel, but I've seen an increase, especially in my my personal seed stage investing. Everybody's jammed the word COVID into their fundraising presentation, which I understand that they, people want to talk about that, and so okay. But I think that's just way overplayed, given the fact that we're 8 years from exit for these companies.
Okay. We have a question from Jay. Do you want to unmute and ask the question?
Yeah. First of all, Eric, thank you for being here. So this is sort of an extension of, I guess, Sasong's previous question. So I was actually, to give context, one of the undergrads that entered venture at a relatively early age. And candidly speaking, a lot of that was due to the allure of the term itself. But what I'd realized after having some work experience there was that had I had previous experience out of startup, sort of some operator experience, it would have better prepared me for that role. So if you could speak upon basically the skills that you had learned as a founder and basically how those skills are transferable, I would really appreciate that.
I don't know that there's a good path. There's a right path. I think everyone, finds their way as best they can through the world. and you look at the people who are the very best venture investors, some of them really have done nothing other than venture their entire lives. And honestly, like if you were to say, what's the fastest, best way to learn venture? I guess I would say it's do venture. And if you have the opportunity to do it, then, and that's what you want to do, there's really no better path for learning it. And it is an apprenticeship craft. And so, if you can do it in a place where you're working with great venture investors, there's no better way to do it. There aren't that many really great venture investors, though. And so doing it with okay venture investors who made money some other place and are coming to do venture because they have money or have access to money, I'm not sure you're going to learn much there that really helps you in the fullness of time. You think of some of the very best venture investors in the world in terms of performance, they come from a really broad set of backgrounds. But to answer your question on what I feel like I bring, and what was useful from founding a couple of venture-backed companies, a couple of things. One of them is around sort of empathy with the founders and recognizing the difficulty of the journey, and that appreciation of sort of I forget whose quote this is, but there's somebody a great quote, right? The rational person looks at the world as it is and says, okay, how do I make my way through the world as it is to my best advantage? And the irrational person looks at the world and says, it shouldn't be like that. I'm going to change it. And that's the entrepreneur, right? And the positive spin on it is all forward progress in society requires the behavior of the irrational person. I have experienced, and I say this lovingly having started venture-backed companies, that a lot of people who start companies, that irrationalism is closely correlated with just flat out craziness in a loving sort of way. Sometimes too far, and in a crazy can't work with them away. But it takes a special kind of person to focus on that world and take on that daunting task of changing the world as it is. So I think that's part of it. I think, and the reason why that's useful, if you think about the sequence of what we do as venture investors of and I'm going to do this sort of chronologically and then talk about importance, you see opportunities, you select opportunities, you win opportunities if it's a competitive deal situation, you work with those companies, to help them be successful, and then you help them exit. Those 5 sequences in time. And everyone in venture talks about, there's so much focus on the selection process and the working with the company's process. And it's people will talk about that at great length. But in terms of driving success in venture, those are not the most important parts. The most important parts are winning access to the very best companies when there are multiple deals, term sheets on the table, and seeing the very best companies. You and I, we could start Jay and Eric Venture Co. and say, let's do, growth stage investing. We found a rich uncle who give us, a few $100 million and we're going to start making investments. And we're okay, great. Let's invest in HashiCorp, Snowflake, Carta, Databricks, Airtable, and Confluent. Let's do those. Done. Right? We've just selected. I can guarantee you those are great companies. But you and I couldn't get access. We could not get access. We could not, no matter how much we want to, we can't make those investments happen because A, we wouldn't even be able to see them. Maybe we could see them. I can get a meeting, but we wouldn't be able to access them. They would do around it they just wouldn't take our check. And so to success in venture is about building how can you get access to the very best companies. That's the hard part.
Thank you.
Thank you. Rohan, you want to ask the next question?
Yeah, thank you. So Eric, as I understand, you're involved currently in the corporate VC space, which is a little bit different from your conventional VC thesis. So this is kind of a two-parter. So number one is, why did you opt to get involved with a corporate VC fund and go with that model? And related to that, what special challenges have you encountered given that you have a responsibility to a parent company as opposed to just a particular set of investors or partners?
That's a fantastic question. there are so many different kinds of corporate venture capital groups. Most of them, maybe 80+%, would be in the category that I would call strategic, where the host company tells the venture team what to do. And there are lots of different ways that the host company can tell the venture team what to do. A few of them are rational, good strategies that help move the business forward. Majority of that 80%, honestly, are I'm going to be a little bit of hyperbole, but to make like a visual point, worse than taking that cash and putting it in the parking lot and setting it on fire. I mean, they're just can't, they don't help the parent company. They damage the brand. I mean, honestly, you'd just be better off throwing the money away than doing what they do in a lot of cases. But I don't want to throw every strategic venture group into that milieu. Like, there are definitely some where they do it in a way that really helps the company, but most of the time, not. Then maybe 10, 20% of them are sort of financial first venture groups. And that's how Deutsche Telekom Capital Partners is set up. So for the investors in the group, we have the same kind of fund structure as any other pure financial investor, with carry and management fee and all that. The part that is interesting and good is that it is a differentiating approach. And so back to this answer to Jay's question, right? Like, so if we formed Jay, Rohan, and Eric Venture Company, and we said, let's go make our first investment in HashiCorp or Snowflake. I know people at those companies. Maybe I could get a meeting, but there's no way they would take our check. But if we get that meeting, and then I turn around and say, let me introduce you to the head of data warehousing business in T-Systems, who has a chance to move $50 million a year of your product through Europe. And then that meeting goes well, and they do initial proof of concept, and something's happening. Like, no deal is signed, but like something's happening. And it happened because of the introduction that we made to that group within Deutsche Telekom. When that next round happens, and the big $200 million check is coming, and we're saying, can we please sneak in our $20 million tiny check alongside them? If it's just Rohan, Jay, and Eric, the answer is, oh, we love you guys, you're super great, but no, the league won't have it. But if we're helping make big chunk of business happen for the business, for the company at like Snowflake or HashiCorp, then we have more than a fighting chance to sneak our $20 million check into their $250 million round. And so that's what's exciting about a corporate venture capital group for the venture investor. And then I'm a huge believer in the power of this model, because Deutsche Telekom had a strategic venture group for a couple decades. And they made a few, like some good investments, some terrible ones. It wasn't like they were misinformed or didn't have a good team. It's just that structure of having the corporate tell the venture team what to invest in is putting the cart in front of the horse. And it's a cart run by people who, like taking the innovator's dilemma approach, the very things that make them really good at doing their job disqualify them from making good venture investment decisions, almost by definition. And so you have people who are well-intentioned and trying to drive the business forward, but they make the wrong choice for the wrong reasons because they don't know how venture works. And so by having a group that is financially driven and saying, look, we're gonna decide on a fund-by-fund basis whether we're happy with what you're doing there at Deutsche Telekom Capital Partners, then not every single investment has to do a deal with DT, but if half of them do, and they're the leaders in their categories, that's 100 times better for DT than if they had 90% of their companies working with DT, but they were in the second or third or fourth tier players because they couldn't get access given the old model. And so I'm a huge believer in that alignment of incentives favors Deutsche Telekom and the few enlightened corporations that have set up these sort of financially driven venture groups much better than the command and control model, because the very things that make them good at their day job in running those companies are directly antagonistic to making good venture decisions.
Thank you. We have a next question from Chloe. She writes, historically, lots of VC activity has been concentrated in the Bay Area in their own backyard. But with COVID, I can see some startups moving away. How has the virus changed how you invest, if at all? And going forward, is it feasible to conduct deals 100% virtually?
So let me take the last part first. So yes, I have made angel investments in companies that I've only met by video. That is possible. I would not do that for a $10 million check. That's a completely different kind of thing. Well, especially when you have an obligation to a broader set of LPs, and you don't want to make a mistake or seem reckless. I think that that's a tougher one, and especially if you're doing it at a stage where part of your investment thesis is about assessing the team. It's hard to assess the team over video. You get some read, but it's nowhere near as high fidelity as if you could meet in person. But then the first part of the question around, hey, will that level the geographic playing field? Will we see a reduction in the concentration of venture activity away from the Bay Area? 10 years ago, I predicted that would happen. I predicted that with the prevalence of information flowing via the internet, that we would see a geographic leveling of the playing field, that places like Cleveland, Ohio could be just as fine and viable a place because you could get all the advice and knowledge and learnings that you needed to get sitting in Cleveland, Ohio, as you could sitting in Palo Alto, California. And I was totally wrong. The last decade has seen an increasing concentration of the very best companies being in the Silicon Valley area. There are a lot of theories behind it, but the empirical data refutes my initial hypothesis around a geographic leveling of the playing field, and so I wouldn't bet against that data, especially after I've been wrong once, for the next decade. I don't think COVID is going to change things much. And the things that would change it were the same things that I thought would level the playing field in the last decade. It just didn't happen. The data doesn't show it.
So Susan Nichols on Facebook asks, do you see greater opportunity as a venture capitalist now with the lack of people willing to give capital?
Well, that gets to the answer from before around the companies that we couldn't get into and us going back to them and getting into one that is an absolutely fantastic company. So yes, but I think also that everyone rushed to go raise money. And so there's it depends a little bit on how the recovery looks, right? If this is a short, sharp V, then it would be fantastic that we got into that company, and any capital you deploy would probably do okay on average. If it is a deep, long trough, then it's a falling knife to invest now, and I think that's driving things. I think I see a segmentation in the venture ecosystem that the very, very best venture firms are continuing business as usual and continue to deploy capital at their usual pace. And the tier twos who are fearful of raising money in their next fund, they're not.
Sisong, you want to go next?
Yeah, thanks again. Hi. Second question. So just with the recent protests and kind of the rise of corporations making a stand against racial injustice to varying degrees, I was just curious about your thoughts regarding diversity, equity, and inclusion within venture capital. I just started working in sales at Google, and they're spending a lot of time just setting us aside to learn about what's going on and the context of it. But I was just curious, as a managing director, what kinds of conversations are you having with people within your network, and how will this change the way you all might go about seeking companies or how you approach mentorship? And I know it's still kind of early and you might be still working through all of this. So, but I was just wondering.
So I think there are huge fundamental problems in our society. So, my own personal experience, I was bussed into a historically Black high school for my years there. And I had come from a totally lily white, like I'd seen maybe 2 Black people in my life before that. Okay, that's an exaggeration, but it just was not part of my regular milieu. And it was shocking to me that sort of the ingrained racism and the self-fulfilling prophecy that comes from that, and what it does to a human being who kind of like, fuck, like what am I going to do, right? I'm in a system where the deck is stacked against me from the beginning, and so whenever I think about racial injustice and or even other kinds of injustice in the world, whether it's gender or race or anything, I think about the front of the pipeline, and for people to end up in positions where like they're an MD at a venture firm, there has to be the big front of the pipeline to drive and enable that, right? Like it has to be the case that they want to be successful in school, not that they have a hopeless view of it. It has to be the case that we're encouraging them to do that. But if we think about like equity, equity in the gender side, like it's maddening to me that none of my daughters wants to be in the computer science class. None of them want to be in the after-school computer science club. And they're like, Dad, that's just a bunch of weird boys in there. Like they're not even the cool kids. And so that makes me sad, right? Because the front of the funnel is where you change society and you get everyone thinking that that's the way the world should be and how it can be. So that's where most of my thinking and points is. They're big, hard issues.
Okay, Professor, do you want to ask a question?
Sure. Thanks, Bob. So quick question, just as a follow-up, and Sasong is working for Google, but sitting in Cincinnati, I think, at her parents' house. Is that where you are remotely?
I'm actually in Chicago. So.
Oh, you are? You're actually in the location. Okay. So many of our students right now, Jay is in Akron, working in San Francisco. So the new distributed model, we actually had Eric Bain, who grew up in Cleveland, went to Cleveland Heights High School, who's the former CEO of Twitter. And we were talking with him last week in this series about remote work. And I'm curious from an investor perspective, as you think about not only deploying capital in companies that may sit in other parts of the country besides the Bay Area, I'm sort of curious about what maybe this period has been right now, or even going forward, about how enthusiastic might you be to invest in a company that has a distributed workforce?
I think the answer is I don't care. At the growth stage, the performance is in the numbers, and maybe as a second order concern, right? If the company is so distributed that I'm concerned about their ability to scale in some place, or their ability to manage complexity as they grow, maybe. But when you're talking about a company that has 20 million of revenue, and you can look at their operating metrics and say, well, okay, for every $1 million of sales and marketing spend, they produce, $1 million of new ARR with 80% gross margin. I think that's an annuity I like to spend money on, and I'm happy to finance that anytime. How they get there, we're going to look at, and maybe it'll raise some flags or concerns, but it's not going to be the primary filter, right? If you look at like the 8 M's of venture, and like the checklist of things that you think through, that kind of issue is pretty far down the list. And you're much more focused on their operating metrics, the size of the market they're chasing after, their competitive position in the market. All of those things are much higher order concerns than scalability of the team or ability to manage a remote workforce. Now, when it comes to my own personal angel investing, I wouldn't say I have an absolute rule that they have to all be in the same room, but it would be harder for me to get excited about a team that was distributed, in part because like, is this a hobby or are they really doing it? Like you really don't care enough to like go be in the same place. There's going to be some benefits, and that most companies fail. And so here's a team that has voted with their feet that they're not willing to take on the thing that will probably help them. For that stage of investment, then I'm a little more concerned.
Thanks, Derek.
All right, so as we almost inch towards the hour, I have one last question. So every crisis leads to pain and suffering, but after every crisis, there are some lessons learned or some events that happen that change that sector forever. For example, for 2008 financial crisis, we had more stringent capital adequacy requirements that were imposed upon the banks. Do you think something similar is coming for the VC space as well?
I think that's a fantastic question. I wish I had a fantastic answer. And by fantastic, I mean, well, maybe the useful, most valuable thing would be like, what would be a fantastic answer to that kind of question? Like a fantastic answer to that question would be right? Like you'd make a prediction about the future and you'd be right. That's obvious. The second part is that it would be actionable from a venture investment perspective. You might say, oh, I think there's going to be more legislation around, category XYZ. You're like, well, okay, well, what venture investment do you make? Like, I'm going to go invest in a compliance company. Like, okay, maybe their capital efficiency is going to go from 0.5 to 0.6 because of this, but it's not going to be like a huge game changer. Is that a game changer for them? I don't know, maybe not, probably not. So like, that's the second part. It's like, is the prediction actionable with respect to a venture investment? And then the third part, I think, this is the hardest part for a fantastic answer, is it a unique insight? That like if you did a 2x2 payoff matrix where the columns are states of nature in the future, and one of them was your prediction was right, and the other one was your prediction was wrong. And like, of course, there's shades of gray in it. But for this simple, it's I guess you're gonna bifurcate the world into you're right or wrong. And then the two rows are states of nature today, which is your opinion is unique, and then the other one is it's the consensus view that everybody would agree to. Of course, if it proves that you were wrong, well then your investment was a failure, right? Like that's a bad comment no matter what. So if that state of nature in the future proves to be antagonistic to your opinion, then you made a mistake and you lose your money. But in the good column of like your prediction was right and you predicted the state of nature in the future correctly, but it was what everybody agreed on, then it's a consensus investment that everybody's plowing their money into, and they're bidding the price up to the efficient frontier. And because idiot venture folks are plowing their money into it and bidding the price up to the efficient frontier, every entrepreneur whose business isn't working very well is thinking about how can they pivot into this thing that's attracting all this magic money from venture idiots. And so then you end up with more competition jammed into that box. So even if that box turns out to be true in the future, it's hard to make a venture return. So to make a venture return, you need to be in that good column of predict the future correctly, but be non-consensus in that prediction. So that's like the hard part of that fantastic answer to your question. So, we can make a prediction about the future. It has to be actionable with respect to investment, and it has to be kind of unique. It cannot be a unique consensus one. And so if I had that view, what I would do is I would make my investment. Once I made that investment, I wouldn't tell anybody about my unique view until I made the investment. Then I would come on panels like this and across the blogosphere, and I would tell everyone about how compelling this view was, so that you idiots would all come pile into the next round and bid my price up in the next round. And that's basically how the Gartner hype cycle works, time and time again.
Yeah.
Sequoia and Benchmark and the people who are really good at this, they make an initial investment in a category, and then they talk the heck out of those companies so that all the follow people who are chatting, listening to their Twitter feed and blah, 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 they're sort of the legal suckers who are talked into marking up the next round. That's a little extreme. I'm using some hyperbole.
No, thank you so much. And I think that's a wrap. So I will just say thank you so much for joining, and back to you, Professor.
Great. Thanks, Bob. Eric, thank you so much. This is a great conversation. I'm not going to brown nose everybody was on. Because of some new friends, a few of my favorite students and old students, including a few folks like Rohan and Sanjeev and Jay that have gotten a little taste through internships in the space. So this is great. It's really timely. It's so awesome to have folks like you that were students at Case and connected back to the university. And I know you've been a great resource in other classes as well. So Eric, thank you so much for staying connected to us. And hopefully when the travel period starts again, there are a number of the students that went with me this past fall out on a trip to San Francisco, and knock on wood, we hope to be back in the Bay Area with some students again this coming year.
Love to see you. Be great.
Awesome. Just a couple of quick announcements while I have folks. First of all, we'll be back with our speaker series on Friday. We're actually branching out into a new entrepreneurial area. We're going to talk about the world of dentistry. So we've got medicine alums, Margaret Richards-Frankel, and Jay Rosenthal are going to be in conversation with one of our alums talking about the dynamics of dentistry and things that are changing, particularly with the COVID crisis. So that'll be Friday at 1 o'clock. Also, I believe Elizabeth is going to put a link. Today is actually the day of giving at Case, and one of the beneficiary areas for the Day of Giving is actually a program that we're involved with the Veale Institute for Entrepreneurship, and actually several of the students. So I know Lori, Nicholas, Rohan, and who else is on my little Hollywood squares here? At least there were a few folks that are all in this remote entrepreneurship program. So we're funding them with $500 of support for the university to work on entrepreneurship programs. So gifts that are made today would go directly to support that program. We have about 110 students right now that are working on a variety of entrepreneurship projects, both in Northeast Ohio and around the country and the world. So for those that are interested, Elizabeth will put a link there and on Facebook. And with that, again, let me thank Bob. Awesome job moderating today. And Eric, thank you again for taking the time, and look forward to seeing everybody back on a future speaker series event.